Welcome, everybody. I see some joining in. We'll wait for one more minute and get things started. Thanks for your patience. All right, I think we are ready to get going. I hope my sound and visual is okay. If you experience any issues with the stream, please let us know through the comments section. Hello, and welcome to our presentation on the DeFi landscape and the DeFi blue chips. Today, we'll explore some of the most important sectors in decentralized finance and spotlight a few long-standing influential projects that continue to shape the space. This presentation is part of our work with the first cohort of the DeFi and Risk Learning Group, an initiative to onboard curious, capable minds into DeFi and Nexus Mutual. Last month, we held a test run to select our first 14 participants, and we are thrilled to be working with them to explore DeFi and risk management together. Again, a warm hello to all of you in the DRLG1 cohort. If you'd like to be a part of the next cohort, you can express interest at nexusmutual.dao.io/risk group. You may find the link in the banner at the bottom of the stream as well. Today's agenda is packed. We will begin with Brave New DeFi, Nexus Mutual's head of product and risk, who will present what I consider the best overview of the DeFi landscape I've ever seen. Brave brings deep experience from both operating in DeFi and building risk products. I am incredibly glad to have him contributing as a risk expert to our first learning group cohort. Today, he will walk us through part one of his two-part series on DeFi and DeFi blue chips. This first segment will cover major pillars like decentralized exchanges, lending and borrowing platforms, and stablecoins. Then we'll hear from Hugh, the CEO of Nexus Mutual, who will walk us through how the mutual operates as a best-in-class example of another critical DeFi sector that is decentralized insurance. From sharing the mutual's earliest architectural designs in late 2010s across Ethereum conferences to leading it today, Hugh has been a central force in its evolution. Much has changed, but the core mission remains the same, using decentralized tools and solutions to offer affordable risk protection to crypto communities and beyond. It's a rare opportunity to hear the Mutual's story directly from Hugh and in real time, and I hope it inspires you to think creatively about decentralized, community-first use cases in your own line of work. Lastly, I'll wrap up today's call by sharing the next steps for the DRLG participants and how everyone, cohort member or not, can benefit from the learning journey and our public resources. Very important, please ask questions. Today's presentations are packed with insights, terms, and definitions that might sound confusing at first. I am confident you will come away with a lot of things to think about, but more than that, this session is meant to help you map the DeFi ecosystem and begin to understand the principles and innovations driving it forward. We hope to see many more breakthroughs and innovations in DeFi in the coming years, and we want them to be built sustainably to support and provide tangible value to communities and ecosystems. Today, this map and understanding this map is a great starting point for anyone looking to be a part of that future. We'll be sharing tools that let cohort participants experiment hands-on with the protocols and project discussed. I will outline those next steps later on, but for now, I want to encourage you again. Please ask your questions. Whether it's in the live call comments or later on the forum, we'd love to hear from you. Okay, without further ado, let's get started. Brave, over to you.
Thanks, Sam. Hey, everybody. Depending on which time zone you're in today, good morning or good afternoon. Today, I'm going to talk a little bit about the major sectors in on-chain and DeFi markets, and I'm going to follow a pretty simple format. So I'll cover 3 major sections and provide a short explanation for each one with notes on the main features present in that sector. And then I'll also go over and talk about the leading protocols in that sector and then some notable risks for protocols in that particular sector. As I'm going through, if you have questions during the presentation, I'm happy to answer those at the end of each section. So if you have any questions when I go through and talk about DEXes or lending protocols or stablecoins, just wait until I get to the end of that. I'll ask if anybody has any questions, and I can take 2 to 3 questions at the end of each section. I'm going to try to target about 10 minutes on each section and everything. So that's kind of the format I'm going to follow. But let's get started and talk a little bit about decentralized exchanges. So decentralized exchanges are peer-to-peer marketplaces that allow users to trade cryptocurrencies directly with one another without the need for a centralized intermediary like Coinbase or Binance. DEXes are designed to be censorship resistant, to provide robust security and self-custody to end users, and to function without any trusted third parties who may selectively restrict access. So unlike exchanges in traditional markets where order books are used to match buy and sell orders, decentralized exchanges allow for permissionless trading using an automated market making model, which uses an algorithmic pricing model based on the available assets in a liquidity pool and the balance between those assets. DEXes play a really integral role in the wider DeFi ecosystem. Without DEXes, you wouldn't be able to trade in on-chain markets, use lending protocols, because lending protocols use on-chain liquidity for liquidations and to provide necessary data for decentralized oracles. You wouldn't be able to exit positions on yield aggregators and a wide array of things. So DEXes are a very, very important piece of infrastructure within DeFi. They're definitely the backbone of a lot of on-chain markets. Looking at DEXes, some of their main features is they're permissionless. So anybody can trade on a DEX. Certain front ends, like the Uniswap front end, may limit the type of trades that you can make due to regulatory reasons, but you can use different front ends to get around this. This is why different DEX aggregators like 1inch and CowSwap are available. You can use a third-party interface to make trades. You don't need a KYC to use an on-chain DEX in most cases. So anybody can trade in on-chain markets. If you compare this to using Coinbase or Binance or some traditional exchange, there's definitely KYC involved, and there's a lot more regulatory scrutiny, whereas you're not going to find that on most on-chain DEXes. And the other part is that anybody can provide liquidity on a DEX and self-custody that liquidity token themselves that represents their position in a liquidity pool, so you can hold that directly in your wallet. And in exchange for providing liquidity to a given pool, you earn trading fees. The other notable thing about DEXes is they've grown to become very efficient. The first DEXes that we saw that launched in 2016, 2017 weren't very efficient and were prone to front running. In the context of on-chain markets, front running refers to an advantage that bots have over human traders. People can program bots to monitor the mempool or the layer of the blockchain where pending transactions are waiting to be confirmed. So if a bot sees an opportunity to make a profitable trade by placing their transaction ahead of your transaction, they can pay a higher priority fee to have their transaction executed before yours. That can result in a bot referred to as a MEV bot, or a maximum extractable value bot, locking in a profitable trade at the expense of your profitability on your trade. We'll talk about this more in the notable risks section. When Uniswap first launched in 2018, they introduced the automated market making model. And this is the model that you'll see used throughout DeFi. This allowed traders to trade in a more efficient, permissionless manner. And all DEXs in the market today are built on that original foundation that Uniswap built. So the first versions of Uniswap, Uniswap v1 and v2, allowed liquidity providers to provide liquidity for 2 tokens across an infinite range. This wasn't as efficient, but was pretty easy for people to set up. Uniswap v2 is still widely used directly or through various forks. So this is what you'll see in a lot of different DEXs. I'll talk about that when I talk about some of the blue chips and which ones are forks and what infra they're using. But with full range liquidity, instead of having an order book scenario, you basically have the formula that we'll get into a little bit more, where you have 2 tokens in a pool, and when somebody trades, they become slightly imbalanced, which impacts the price of those tokens, and then slowly through arbitrage between different markets, it comes back to equilibrium, and that is the way that permissionless trading can happen on chain. In 2021, Uniswap v3 launched and allowed users to provide concentrated liquidity in a defined range. So instead of providing liquidity across an infinite spectrum, you could specify the price ranges where you wanted to provide liquidity. So with concentrated liquidity, you could have a lot more efficient trades, but this also introduced greater risk for impermanent loss, something again that I'll talk about in the notable risks section. And then in 2025, just this year, Uniswap v4 launched, which with improved features like hooks, which allow for greater customization and variable fee ranges for liquidity providers. Uniswap v4 is still kind of growing adoption. It's a lot more advanced, and so there's a lot of people working to kind of abstract away some of the complexity in Uni v4. But those primitives in Uni v4 and Uni v3 are really important, and we'll talk a little bit about how that's influenced some of the other DEXs. But ultimately, DEXs that allow for concentrated liquidity can handle greater volume with less liquidity, and that provides a larger share of fees for liquidity providers using those different protocols. It's not uncommon to see protocols like Aerodrome or Uniswap seeing greater trading volumes than Coinbase on any given week. So let's talk a little bit about the differences between DEXs and traditional order book exchanges. Again, DEXs are really vital infrastructure, but to understand why they're important and where the innovation lies in on-chain markets, we need to understand the difference between decentralized exchanges and traditional order book exchanges. With a decentralized exchange, you can self-custody your asset versus traditional exchanges. You're looking at the custodial management of funds. Even if we look at something simple like Coinbase or Binance, your funds are on the exchange. Your funds, the custody of those funds are managed by the exchange. You can place buy and sell orders, but ultimately you're not custodying those assets yourself. They're being custodied by somebody else. So that's a really big innovation in and of itself. You can make a trade, you can set up orders, you can keep assets in your wallet until trades are executed. You can provide liquidity and then have the LP token held in your wallet, so you have complete custody over your assets. With DEXs, you're relying on smart contracts to execute according to the logic that's programmed in those smart contracts. So you can set it up with different parameters to say, this is the slippage I want, or this is basically the change in price that I'm willing to tolerate in the swap. You can set the price impact that you're willing to accept. You can set different parameters when you're making a trade. And all of this is done through the smart contracts. If you're using, again, like a centralized exchange, you're relying on their centralized server, their centralized infrastructure to actually execute the trade. Again, one of the big innovation is how liquidity is managed. So is it through an automated market maker, or is it through a centralized limit order book, right? So centralized limit order books, one could argue, are more efficient, but again, they're centralized and you're relying on a third party's infrastructure to execute that trade, whereas AMMs allow for you to have permissionless trading. With a DEX, anybody can provide liquidity, whereas if you're looking at a centralized exchange, the people that are mainly providing liquidity are market makers and institutions. While there are some opportunities for retail there, it's largely market makers and institutions. The same can be said for DEXes. There's a lot of institutions and market makers who are providing liquidity, but providing liquidity is a lot more accessible in on-chain markets, though it is somewhat of a more advanced activity. Looking at pricing, centralized exchanges are using bid-ask pricing, whereas you have algorithmic pricing in on-chain markets. And again, all of this is arbitraged by different bots to keep pricing similar across different DEXes and on-chain markets. We talked about this before, but there's no KYC for on-chain DEXes versus KYC to access on centralized exchanges. On the one hand, DEXes are very censorship resistant, and centralized order books are highly centralized. So you can have different failures like we saw with FTX, where there's not as much transparency, you can't see into what's going on, and all of a sudden one day, withdrawals are halted, you don't have custody of your assets, and then you're in big trouble, whereas this doesn't happen with a permissionless, immutable model like Uniswap uses. There are different fee structures involved. So when you're looking at on-chain markets, you're paying gas fees, the protocol fee, which typically for a lot of trades is 0.3%, 0.1%, or for some stablecoin trades, like 1 basis point. When you're looking at traditional order books, you're looking at trading and withdrawal fees, sometimes other charges that aren't as clear. This goes back to transparency. Everything as far as the fees go, the assets that are available in liquidity pool, you can see that all on chain, it's fully auditable, whereas things aren't as transparent and clear on traditional exchanges. On the speed and finality part, this is actually the interesting part. So CLOBs are actually faster execution. They have faster execution than a lot of on-chain markets. However, with some of the improvements that are being made on-chain, we're seeing faster fulfillment of trades, but it's dependent on the blockchain throughput for finality in trades and on-chain markets. And then on the regulatory side, DEXs are not regulated, right? They're unregulated or minimally regulated, whereas traditional exchanges, even centralized exchanges aren't subject to as much regulation as, let's say, traditional exchanges. There's still a lot more regulation in play for centralized exchanges and traditional exchanges than we see in DEXs. So those are a lot of the main differences. If we talk about some of the blue chips in the DEX sector, again, we've talked about Uniswap, Curve, and Balancer. So I would say these are 3 of the biggest players. Uniswap has been around the longest. They're kind of one of the precursors to DeFi Summer with Uniswap v1 and then Uniswap v2. Uniswap is the most forked protocol in DeFi history. And again, some of the ones I'll talk about here are actually Uniswap forks. So Uniswap has excelled in establishing that original format of y times or x times y equals k, the AMM pricing algorithm that's used. And this has been adopted by a lot of other folks. Whereas Curve, when they launched in 2020, Curve came out with advanced like-kind asset swaps. So whether that's stable coins or ETH to ETH LSTs, like-kind asset swaps are very efficient on Curve, and the way that Curve is designed, it kind of has an edge over Uniswap, or at least it did. Some people would argue that it's superior DEX to Uniswap. There's arguments about this across these 3 major DEXs across the board. These 3 DEX protocols, though, Uniswap, Curve, and Balancer, have set an industry standard in one way or another. So again, Uniswap, the first automated market maker, and remains the leader in the decentralized exchange landscape. Like we talked about before, they introduced that constant product formula and the AMM model in 2018. And Uniswap has 4 different versions that we've talked about. Uniswap v2 and v3 are the most popular, and v4 is the newest iteration. For liquidity pools, each token pair is pooled together and traders swap against the pool. That pricing algorithm that we talked about, that constant product formula, X times Y equals K, where X and Y are the quantities of each token and K is that constant. This is something, again, that's used throughout DeFi in one way or another. They use an AMM, so they can automatically adjust prices based on trades. The concentrated liquidity that was introduced with Uniswap v3 improved a lot of capital efficiency, and that's been adopted by protocols like Aerodrome, Velodrome, and PancakeSwap. Since Uniswap launched, they've had over 1 trillion in trading volume, which is very impressive. And Uniswap v2 and v3, again, are the most forked protocols. People have made minor changes to the protocol code base, and they're launched under a different brand. So when we talk about a protocol being forked, we're talking about somebody copying the code base, making some changes, and then launching under a different brand. Aerodrome and Velodrome, I would say, are two of the more popular ones. So they were both Uniswap v2 forks that had a different incentive model attached, right? So the VE Velo and VE Vero and Aero incentive model, where the trading fees go to buy back the governance token, whether it's Velo for Velodrome or Aero for Aerodrome. And then this is what gets provided back to liquidity providers who are staking their LP tokens. So there's this bootstrapping phase for the token that allows for greater efficiency and incentives. And this allows people to bribe different markets and drive incentives to different liquidity pools, which increases liquidity. So this model has been very successful, but they're fundamentally using Uniswap v2. When you look on Aerodrome and Velodrome and you see the concentrated liquidity pools, those are just forks of Uni v3. The same is true for PancakeSwap. PancakeSwap is a Uniswap v2 fork that launched in 2020. It launched in September of 2020 versus another one, SushiSwap, which I'm sure folks have heard of. SushiSwap also launched in August of 2020. So Uniswap v2 came out earlier in 2020, and then immediately after there were forks, PancakeSwap and SushiSwap. Both of these have since forked v3 and have concentrated liquidity pools. And again, they're just modifying the token incentives that are provided, whereas Uniswap traditionally does not provide a lot of token incentives. They did early on in their history. They have some proposals to do so now, but PancakeSwap, SushiSwap, Velodrome, and Aerodrome rely heavily on governance token incentives to boost yields. Looking at Curve was originally created to optimize stablecoin trading by minimizing slippage and impermanent loss using the AMM model tailored for assets with similar prices. So stablecoins like USDC, DAI, and USDT. And then Curve expanded into other markets as well, like ETH LSTs, Bitcoin derivatives. So they pioneered the concept of concentrated liquidity for like price assets, and they significantly reduced slippage compared to other DEXes. Back in 2020 and 2021, the Curve 3 pool and some of the other, like the Try Crypto pool, were used significantly for trading volumes between different markets, and a lot of the yield aggregators that we'll talk about in our next session relied on those liquidity pools for a variety of things, for pricing, for swapping through things. Curve also introduced VE tokenomics, so a yield boosting. I don't have time to go too much into depth on VE tokenomics, but as just a general highlight, the VE model allows CRV governance token holders to stake and lock up their tokens for anywhere from 1 to 4 years in exchange for trading fees. The longer that somebody stakes their tokens, the greater the share of trading fees they earn. And so if you've locked up your tokens, you're earning trading fees, and you also get to vote on where CRV token incentives are directed to different liquidity pools. And because of this, there's basically something called the Curve Wars, where different protocols were trying to amass a lot of CRV tokens so they could then direct incentives to their own liquidity pools to benefit themselves. Yearn and Convex and other protocols that were participating in this ecosystem looked to do this, and this drove a lot of volume and a lot of attention to Curve. This has since been copied by a lot of other protocols like Balancer, Velodrome, and Aerodrome as some notable examples. And Curve is widely used in stablecoin strategies, liquid staking derivatives, and people that are building DeFi native fixed income products. Very interesting. And I'm going to run through Balancer real quick, and I'll run through some risks. I am a little bit over 10 minutes on this. Balancer is interesting because they have programmable liquidity pools. So unlike traditional AMMs that have like a 50-50 token pools, you can have different spreads in Balancer that help reduce impermanent loss. So you can have 80% of ETH and 20% of a governance token, or vice versa. You can also have more than 2 assets in a liquidity pool. And so the Balancer team has expanded the programmability in these liquidity pools in V3, which launched in Q4 of 2025. So they have multi-asset pools, self-balancing portfolios within those liquidity pools. They have smart pools with dynamic programmable parameters like fees, weights, and access controls. Balancer V3 also incorporated hooks, which is inspired by Uniswap's V4. And then they also have pools that are 100% boosted, meaning the underlying assets are put into protocols like Aave. And a lot of major protocols like Aave and Rocket Pool are using Balancer as a fundamental part of their treasury and incentive management systems on chain. The notable risks, I'll run through these really quick. We're going to have another session on risk where I can go into things in more detail. Impermanent loss is something that's very unique to DEXes. So impermanent loss, you're going to incur that when you provide liquidity to a pool on a DEX. And what is it, right? It's the temporary loss in value that liquidity providers experience when the price of assets in a liquidity pool diverge from their original value at the time of deposit. So it's the opportunity cost of being a liquidity provider when price movements affect the value of your deposited assets compared to simply holding them. This is also referred to as divergence loss. So when you provide liquidity in a DEX, you're basically buying a token as it goes down in price and selling a token as it goes up in price. So if you provide liquidity for ETH and USDC, you're selling USDC for ETH as the price of ETH goes up, and you're selling USDC for ETH as the price of ETH goes down. So as a liquidity provider, you're hoping the trading fees you earn offset that impermanent loss you experience. And impermanent loss is the greatest in pools where volatile assets are paired together, like ETH and USDC, and like-kind assets like ETH and wrapped staked ETH, or ETH and WNXM, USDC and USDT, are less likely to see large degrees of impermanent loss because they're correlated assets. Just as a note on this, Nexus Mutual doesn't cover impermanent loss because this is largely driven by market volatility and can be hedged using derivatives. Front running is something that we also talked about. This is when bots basically can execute trades and conduct different kinds of attacks on people. But this is basically like the loss of value. You can avoid this by using things like CowSwap or using an RPC like Flashbots that basically submit your transaction directly to the mempool. That's a little bit more advanced. We'll talk about this in the risk section that we cover later. And then, of course, smart contracts hacks, because funds on DEXs are held in smart contracts. Flaws in that smart contract code can be exploited and lead to a loss of funds for liquidity providers. So just last year, there was 456 million in losses on DEXs due to things like reentrancy attacks, price oracle manipulation, and logic bugs in AMMs. Again, we'll talk more about risks in another session, but in the interest of time, I'm going to move on to lending and borrowing protocols. So while DEXs are vital infrastructure in on-chain markets, I'd argue that lending protocols have the greatest impact on DeFi's yield landscape. We're going to talk more about yield aggregators in our next session, but it's worth mentioning that the vast majority of yield aggregators are running various strategies that utilize lending markets to boost the yield in their vaults. So let's talk a little bit about lending protocols, the different types of lending models, and the main use cases for on-chain lending. If you're in DeFi, you're aware of DeFi lending, you've heard of Aave before. But before Aave was a lending juggernaut, they started out in 2017 as a peer-to-peer lending market called ETHLend, where people could lend and borrow crypto assets directly from one another using smart contracts on Ethereum. So ETHLend brought trustless loans to the blockchain using collateralized debt agreements between individuals. Borrowers had to lock up ETH as collateral to secure loans and other ERC20 tokens. During the ETHLend era, borrowers had to create loan requests where borrowers specified the amount of funds they wanted to borrow, the interest rate they were willing to accept, the loan duration they were looking for, and the type of collateral that they were going to provide. Lenders would then review the available borrowing requests and decide which request they wanted to lend crypto assets to. As you can imagine, this model wasn't incredibly scalable. It was a pretty advanced activity. So peer-to-peer lending markets are not incredibly scalable. And Aave decided to make a pivot to a different model. You can still find peer-to-peer lending markets in DeFi like Pwn, but they don't have a large amount of funds in their contracts. And again, they're not very scalable and they're not very friendly for mainstream adoption. So what Aave did in 2020 is they switched over to Aave v2, which uses a peer-to-pool model. And a peer-to-pool model is one where lenders and borrowers don't need to manually find each other. Instead, they interact with each other through shared liquidity pools across different markets. This is a lot more capital efficient. This simplifies the user experience. So when you go into Aave now and you want to lend USDC, you lend that to the USDC market and you earn an interest rate. If I go in and I provide ETH as collateral and I want to borrow USDC against that, I'm borrowing USDC from that shared liquidity pool and I'm paying interest. And the protocol takes the spread between the amount that they charge me as a borrower and the amount that they're paying out lenders. So that is where Aave makes their profit. The benefit of this is you can have people providing collateral in multiple markets and they can all borrow USDC. But this creates something where you have correlated markets. So the risk of one of the collateral types, let's say it's something like Athena's staked USDE, if there is some loss event and those tokens can't be liquidated in a timely fashion, that creates bad debt. And anybody who is lending out their USDC to people that are providing SUSDE as collateral are going to suffer some losses. And this is true because all of these markets are correlated. They're not isolated from one another. But to date, that peer-to-pool model has been the most popular model in DeFi. It's the most scalable and the most capital efficient. Lenders and borrowers don't need to coordinate with each other. They coordinate with each other through that protocol, and it handles all kinds of different parameters. Aave manages their settings in the peer-to-pool market using governance. So they set the loan to value for markets or how much a borrower can borrow against their collateral. They set the liquidation threshold or the value of a borrower's collateral versus their outstanding debt. They set the interest rate. Interest rates are automated in most lending protocols. Major protocols like Aave, Spark, and Compound use a jump rate or a kink rate model. So they have a certain utilization rate. Once you hit that, the interest rate jumps up quite high, but until you hit that utilization rate, the interest rates climb up very gradually. So this is kind of like the main defining features of the peer-to-pool lending model. So while you have a lot of capital efficiency, you have more correlation between the markets. And so we've seen permissionless isolated markets pop up. This has been something that's been ongoing for the last, I would say, 4 years, people trying to launch permissionless markets. But we haven't seen a lot of success until protocols like Silo and Morpho came around. So they're using a peer-to-pool model, but it's slightly different. It's not as capital efficient. Using Morpho as an example, a risk curator can come in and they can create a series of markets where they define in each market the accepted collateral for a market with just one asset as accepted collateral, the lending assets for a market, again, just one asset, the loan to value or how much a person can borrow against that deposit collateral, the oracles that are used to track the value of the collateral on loan assets, the interest rate model and the target utilization rate, and then the liquidation penalty. So once they set these parameters in a protocol like Silo or Morpho, they can create an immutable lending market where borrowers can now provide collateral and borrow against the available token. And those immutable contracts cannot be upgraded. Whereas in something like an Aave or other peer-to-pool models, you can't upgrade those contracts. So each market launched on Morpho is isolated, meaning it doesn't share liquidity with the other markets. So what Morpho has done to allow for greater capital efficiency is they launched Morpho Vaults, which is another protocol built on top of the Morpho markets layer. So risk curators can manage the loan token assets in a Morpho Vault. So let's say they have a USDC Morpho Vault, and then they can allocate those loan tokens at USDC to different markets where they need USDC liquidity. So you're then relying on the risk curator to choose the best markets with the most quality assets to earn you the highest yield, and their incentive is, of course, earning a management fee for that. So because you have these isolated markets, if one market fails, again, if there's one SUSDE market that fails, the losses in there are going to be limited to how much USDC liquidity is in there and whatever bad debt accrues to that market. That contagion won't spread through the other markets. So you have less capital efficiency, but you do have a little less risk because markets aren't correlated. But again, in a permissionless market, you really need to know what oracles are being used and if the assets that are in different markets are quality assets that you want to actually lend your assets against. And then we have things like collateralized debt position protocols, like Sky, or formerly Maker, Reflexer, and Liquidity. These are different. These protocols operate more like neobanks on chain. So you put in an asset in a vault, it does not earn interest like in the other two models. And then you're borrowing against it for a defined interest rate, which is set through governance. So when you get that, you're generating a new token. So for Sky, you're putting in ETH or some ETH derivative, maybe stable coins, maybe real world assets, and then you're minting USDS, which is their stable coin. Then you can go out and use that. In all of these cases, you're talking about over collateralized lending. If we move on to the next slide, we can kind of see the differences. So all of them are over collateralized, but in the CDP market, borrow rates are set by governance. They're not using the same algorithmic dynamic pricing model that's used for the interest rates in peer-to-pool or permissionless isolated markets. You have an automated liquidation process in all three, and immutable contracts in the CDP protocol model. You have the same thing in permissionless, but most peer-to-pools have upgradable contracts. And CDP vaults are isolated by default, right? So you can have different vaults that get liquidated, but ultimately those vaults are not correlated to one another. The benefit with the CDP protocol is you can have a certain defined collateralization level that you need to have, but you can take the underlying assets and allocate some of those funds to things like RWAs, which is what Sky Protocol does. They put those in US Treasuries, and then they take that yield and pass that on to USDS holders that stake in the SUSDS vault. So collateralized debt protocols have been around for the longest amount of time. Maker first launched in 2017 and is basically the first lending protocol. They've since been kind of overtaken by Aave, but they are still a very large and very influential lending protocol out there. So these are the three main types of lending and borrowing protocols. If we move on to the next slide, we can see different examples. Again, on the CDP side, you've got Sky, Curve Llama Lend, Liquidity, Level Finance, Inverse Finance, and FX Protocol. You can see that the largest one by TVL is Sky Protocol. And then if we look over in the other categories, we can see that there's a lot more happening in the peer-to-pool model, with Aave leading the pack at about 20 billion in TVL. You've got Spark Protocol, which is an Aave v3 fork that has a little over 2 billion. Compound, V2 and V3 has over 2 billion. Venus Protocol, which is a Compound V2 fork, has a little over 1 billion. And then some of the other ones, Fluid, which is more novel, has about 770 million. And then Moonwell, which again is a Compound V2 fork, has about 200 million. Looking at the permissionless markets, you've got Morpho, and they've got over 2.7 billion as well. So you can see peer-to-pool is still leading the charge. If we look at some of the risks that are specific to these lending markets, on the next slide, with lending protocols, they are some of the most complex protocols. So you're relying on oracles to fetch prices because smart contracts themselves don't know what the price of assets are. So you're relying on oracles, whether they're chain-link oracles, whether they're fixed-rate oracles or hard-coded oracles. A fixed-rate oracle is one that's manually updated by someone, and a hard-coded oracle is one where, let's say, USDC is hard-coded to $1 in price. Oracle failure manipulation has led to quite a few losses in the past. Definitely in 2020 and 2021, we saw the greatest range of losses. For some examples, we've got Cream V1. That exploit led to 130 million in losses. This is an event that Nexus Mutual paid out for. This was due to Oracle manipulation that allowed somebody to borrow basically all of the TVL in that protocol and steal that. The same happened with Mango Markets. There was Oracle manipulation that led to a loss of about 120 million. This was on Solana. This was a very much talked about event. There was another one on Compound V2 where they were using a centralized Oracle that failed, and the price of DAI was basically manipulated, which led to liquidations totaling about 90 million. That happened in November of 2021. Yeah, so this is kind of when we start seeing the trend of people switching over to decentralized Oracle feeds. And then inverse finance, which saw Oracle manipulation that led to about 60 million in losses. Liquidation failures have resulted in some losses. So MakerDAO Black Thursday is probably the most talked about one, where they had a design flaw. During a time of very high gas fees, when the price of ETH crashed, there was somebody who had no competition that was submitting zero DAI bids. So they were bidding on ETH lots or ETH vaults that could be liquidated. And they were bidding on that for $0. And they were able to win because there was a design flaw in the system. And that led to over 8 million in losses back in 2020. Aave V2, they had a curve liquidation spiral. This was due to insufficient liquidity in the market. So when the position started to be liquidated for a large CRV loan position, they weren't able to liquidate it, and it resulted in about 1.78 million in bad debt. And then most recently, we had Term Finance, the TETH liquidation failure. This was due to how their liquidation process was set up, also some Oracle component to it, but this led to a loss of 1.66 million. Governance attacks, not as common, but we've seen them. Beanstalk is probably the largest one, where somebody basically was able to attack governance, take over the protocol, and steal over 180 million in assets. And then smart contract hacks due to reentrancy or logic errors that have led to a sizable amount of hacks. Some of the ones I've included here is the Rare Capital hack, which we paid out for, the Euler Finance hack on their V1, which we paid out for. Compound, there was a hack that resulted in a bunch of comp tokens being released that led to a pretty large, significant loss. Zone Finance, which was a Compound V2 fork that was hacked for 20 million due to a known issue. And then a Cream V1 hack that happened due to reentrancy for a little over 18 million. So there's a lot of different things that can go wrong in lending and borrowing protocols due to lack of liquidity, due to Oracle failure, liquidation failure, smart contract hacks. There's just a lot of dependencies and a lot of assets to look at in a lending protocol. So there's actually quite a bit of risk in lending protocols. When we talk about risk in our next section, we'll definitely dive into some of these more in depth and talk about these. But now, before I hand it over to Hugh, I'll just say I will cover stablecoins, yield aggregators, and real world assets during our next session, because I've run a little bit over and definitely missed my 10-minute mark. So I'll hand things over to Hugh to talk a little bit more about Nexus Mutual.
Thanks, Brave. All right. Hey, everyone. Yeah, just thought I'd run through Nexus and basically how it works from a mechanics point of view and what roles and what you can do within the system. So I know I don't have a whole heap of time left, but feel free to ask questions, follow up or after, and we can pick them up. I also wanted to note that there's a whole bunch of questions that people asked a few weeks back, and we can, I was thinking about going through them with Sam and perhaps recording something separately so we can get back to most of you with some answers on some of those as well. On the Nexus stuff, so I think the first thing is the best way to think about Nexus is it's a single mutual. It has a shared capital pool, and all of the assets of the mutual are held in that kind of one capital pool. And I think it's easy to think about, okay, so we have one capital pool, so what goes in and out? What are the cash flows? And if we run through those quickly, there's only actually 5 of them. And so it's actually reasonably simple when you think about it at a high level. So we have cover costs, or I guess premiums that come in. We have investment returns, they come in. And then we also have capital contributions, they come in. So when people deposit Ether into the pool. And then the outflows are basically claims or capital redemptions. So when people take money out of the pool. And so there are kind of rules on all of these about how they actually work. In terms of what assets make up the capital pool, it's roughly 90% ETH based and 10% stablecoin based. That does shift with ETH price, etc. But that's just a kind of high level. The ETH is mostly invested in ETH staking derivatives, so like Lido staked ETH or ETHFIZ ETH, etc. There's a bunch of them there, and the investment returns do vary, but probably about maybe 3%, maybe a touch lower than that, but roughly that level per year. And at the moment, there's about 120 million of assets in the pool. So that's kind of the basis with which we need to kind of think about the mutual. One share capital pool, about 120 million, and there's only 5 cash flows. So that's kind of the main thing. Keep that in mind. Moving on to the next one. So all of those assets are effectively collectively owned by the members of the mutual, and those are the token holders. And so the NXM token essentially represents ownership rights in the mutual. And the best way to think about the token is its ownership plus an incentive layer. So think about it as this incentive layer that sits above the capital pool, and it encourages the aligned long-term behavior that the mutual needs and wants to succeed. So I guess insurance or coverage is all about aligning the incentives over the longer term, paying out the right claims, and doing things because you need to kind of lock capital long term, etc. as well. So all of the incentive structures are designed to align incentives over the long term, and that's kind of when you get this success. So there are a whole bunch of ways you can effectively contribute to the mutual, and you can earn incentives, and you earn those incentives in NXM terms. The first one is when you contribute capital. So if you deposit capital into the pool, Ether into the pool, you mint new NXM. If you underwrite risk or stake, you earn rewards when people buy cover, and you can also be burned when there are claims. So I'll get back to that in a bit. Then you can also earn incentives for assessing claims and for voting in governance. And those last 2 categories are a bit smaller in terms of magnitude of incentives, but they still are there and an important aspect. So I guess the most complexity around the mutual and the kind of incentive mechanisms are really kind of 2 main aspects. And the first is kind of the staking aspect and the cover buy aspect, and that kind of how that fits together. And the second aspect, which I'll get on to in a bit, is the capital contribution and redemption. So on the staking aspect, essentially we have staking pools. So any member of the mutual can create a staking pool, and these are kind of risk experts. And then you can have other NXM holders that can delegate stake to that staking pool, so they can effectively go, yeah, I trust you. I think you can do a good job on risk, and therefore I'll delegate my NXM to you, and then I'll proportionally earn some rewards. And then on the other side, we've got the cover buyers who actually buy the cover, so they pay the cover fee. So on the next slide, just in a little bit more detail, the stakers or the staking pool managers, so NXM is staked in those staking pools, and general members will delegate stake to the staking pool managers, but the managers are the ones that set the prices and capacity levels per risk. So they might go, I think the price of this particular risk should be 2%, so I'll set it at 2%, and I only want to be exposed to 1 million of capacity on that, and so I'll set a maximum limit, and you set that at NXM terms of weight. And if you have 1 million of NXM delegated to your pool, you can open up so $1 of NXM opens up $2 of capacity. So there's a kind of gearing effect that you get. On the kind of reward side, when there's a cover buy, when that happens, 50% of the cover cost or the premium is minted as additional NXM rewards. And so what happens is that's then effectively after the management fee is taken out by the staking pool manager, so usually about 10% or something, then the remainder of the rewards are streamed to the stakers on a proportional basis. So if someone delegates 10% of the NXM, then they get 10% of the rewards. On when there's a claim, or if there's a claim, 50% of the claim amount in NXM is burned, and that's proportional burn against the stakers as well. So it's definitely the money is at risk here. And so overall, it operates like a 50-50 quota share. So if you manage risk well and do it on I guess a profitable basis, then effectively that's shared amongst all the people that delegate their stake. And so roughly at the moment, there's about 16 or 17% of the NXM of the total NXM supply is staked and active and effectively underwriting risk for the mutual. The other more complicated aspect of the mutual is the capital contribution and redemption process. And this is managed by what's called a ratcheting AMM. So Brave talked about AMMs in general. We have effectively a custom one built for Nexus, which handles the contribution and redemption aspects. So contribution happens when someone contributes Ether. So this is in the above pool, and then they get NXM. And on the below pool, and I'll get to these in a minute why they call that, is when someone burns their NXM and returns and gets Ether in return. So that's the redemption. So in the above pool, you've got the contribution, and in the below pool, you've got the redemption. So in a little bit more detail on the next slide, there's the important concept here is the book value. So the book value is where we have the total assets of the mutual. So it's like what's in the capital pool, so 120 million, and you divide that by the number of NXM in total, so the total NXM supply. And that's kind of the assets backing one NXM token. And so what the RAM does, it only allows contributions above book value, and it allows only redemptions below book value. So it raises money when the price is relatively low compared to its book value, and it lets money go, and it is happy to let money go out when it's high relative to the book value. And this means that each capital contribution or redemption is actually value accretive to long-term holders. So if you stay in for the longer term, you essentially get more value accretive to you, because there's a little bit of slippage that happens, or the slippage that happens effectively accrues to all of the remaining members of the mutual. On the AMM, so the AMM side, it's effectively two one-sided automated market makers, one for the above book value pool and one for the below. And they're Uni V2 style, so X times Y equals K. And so the ratcheting aspect of it means over time, because you're only allowed to place one side of the trade on each of the pools, how does the price go back the other way? And so this is the ratcheting mechanism. And the ratcheting mechanism basically means that the price drifts towards book value in each pool slowly over time. And then when someone makes a trade on that pool, then it slips and the price goes up like a ratchet. And effectively what this means is that you kind of got a continuous Dutch auction mechanism working in both pools. So visually, this is a bit of a simulation. You don't really have to look at the details, but this is kind of where the ratchet name came from. So what happens is on a big, like this is the below pool. So when someone wants to redeem amount of ETH out of the pool, what happens is they do that redemption, the price drops down, and then it slowly ratchets back up. And then someone else comes and does a smaller sell, and then it drops down, and then it slowly ratchets back up again. And so that's kind of the we did a whole bunch of simulations when we kind of came up with the mechanism, and this is kind of the result of that. So that's kind of what it looks like at a high level and where the ratchet name came from. On all of this stuff, there's heaps more docs if you want to dive in a bit more into a bit more detail, but I'll kind of quickly run through some of the other pieces. On the claims, effectively, there's a voting system where any member can participate, noting that this may change in the future, by locking NXM. And it effectively operates like an optimistic oracle. And what that kind of means is the claims can resolve quite quickly with low participation, because it's only efficient if a few kind of experts vote. And so that's kind of what happens, and that's how the vast majority of claims get resolved. And then if there is disagreement and people vote in different ways, then effectively the voting period extends and allows other people to participate. So most claims are resolved in 3 or 4 days, but they can extend out for a longer period if there's kind of that disagreement. On the incentive side, there's kind of a small operational like rewards for voting participation. Then there's kind of this big stick where the advisory board, which is a five people in the mutual, have kind of higher powers than others, and they can burn stakes if there's deemed to be fraudulent activity happening. I've had to do it once in the past for an obvious fraud that occurred. So and effectively the burn stopped the fraud and prevented the claim payment. And so long term, what this means is we've got a high level alignment to pay all valid claims because people stake. Longer term, and short term, we have a severe punishment to deterrent to stop attacks. So that's kind of how the incentive mechanism works. And the idea being that we want to pay all valid claims. Moving on. Oh no, that's it. Sorry. I think that's it. So happy to hand back over to Sam, but also please drop some questions in the chat, and I can pick them up next time or on the wider call. So thank you.
Thanks, Brave. Like you said, please, if you have any questions right now, post them wherever you are in the comments section, or you can also visit our forum and search for DeFi AMA and come across a post where the cohort members have already shared their questions and add your question there. Okay, let me recap the next steps for the learning group participants. Every month we have a new challenge that the cohort participants should complete if they want to stay in the cohort. We think learning really happens if you do hands-on stuff, and we also learn from each other. And yeah, this month's challenges. The first one, choose your focus and read the material outlined on the forum. Post your questions. We have selected key readings for each focus area and will be forming small groups within the cohort to dive deeper into them. Focus areas will be filled on a first-come, first-served basis, so please pick your topic early. And would also love for at least one member from each group to volunteer to share their insights and learnings during the next open forum session. Number 2, provide feedback for the curriculum. Ask any open questions from this session. This cohort will run until the end of July, and we had a few questions on YouTube, I think, about when the next one will begin or whether people can officially join this one. Unfortunately, the applications for this current cohort are closed, but we'll be taking in another cohort after July. Anyways, leaving that side note beside, cohorts participants will be getting to do some experiments through a small stipend as part of the curriculum, as part of the content we have planned for the next couple weeks. We're also planning to demonstrate how to use a DeFi project together in an upcoming session, host guest speakers, and talk more about contributing to the blockchain risk working group, which we're co-leading with Jeremiah and OpenCover. So all this is included in the curriculum draft that we'll shortly share on the forum. Your feedback is very important. Please let us know what is working and what you'd like to see more of. Last but not least, please make sure to join the session on the 21st of May, as we'll have the rest of the DeFi Landscape and Blue Chips presentation there. And if you can't join, please catch the recording. It's also going to be uploaded on the forum as well. And like Hugh shared, he will soon be answering the cohort's first set of learning questions in a special DeFi AMA style video, and we'll make sure it gets to you. Okay, we are slightly over time today, but I think we're still good. If you have any urgent questions, please post them now. Otherwise, please feel free to share them on the forum. I will send an email to the cohort participants latest by tomorrow where they can ask their questions and discuss together as well. But I think this was a really packed presentation that ultimately serves to show how one learns about DeFi and how one stays informed. I think it's a lot to do with reading and reading documentations and experimenting. Am I right, Brave?
Sorry, Sam, could you say it one more time?
Oh, I was saying, I guess learning about DeFi has a lot to do with reading documentation.
Oh, yeah. Reading documentation, reading governance forums, and just reading a lot of things.
If you like reading, you're in the right place. So, okay, I think we are ready to close the call for today. Thanks everybody for joining us. We will see you at the next one in 2 weeks, where Brave will cover the rest of the DeFi landscape presentation, and we'll talk a little more about Nexus Mutual as well. Take care. Bye.